So this video is for class 30 in the Monday, Wednesday, Friday series. It's the first video, so 30A. If you're in Tuesday, Thursday class, we're continuing with class 21, so this is 21C. And we're actually on to a new chapter. We're going to start talking about liabilities. So the last few chapters we've been working our way down the balance sheet, so we've been on the asset side, so we've completed with investments. We've completed the asset side of the balance sheet. So now we're going to talk about some specific details about the liability side of the balance sheet. So we're going to start out with current liabilities, and we're going to throw a little bit of payroll discussion in there because payroll typically becomes a current liability. You know, we have some wages payable that last till we get the paychecks. Sometimes a day, sometimes maybe a week at the most. All right. So 30A for Monday, Wednesday, Friday, 21C, Tuesday, Thursday. So let's start talking about current liabilities. Alright, so I think you probably remember a little bit about liabilities, that they're debts that are owed to creditors. Liabilities have three main characteristics. Alright, so we're going to talk about that right now. Up to this point, we've been focusing on all the assets the corporation owns. But what about the bills a business owes? A business needs to know what it owes, its liabilities, and by what date the liabilities have to be paid. Liabilities are debts that are owed to creditors. Liabilities have three main characteristics. They occur as a result of a past transaction or event. They create a present obligation for future payments, and they are an unavoidable obligation. So something happens that causes us to owe somebody, and we have to pay it. So it's unavoidable. How are current liabilities accounted for? Liabilities can be split into two main categories, current and long-term. A current liability is a liability that must be paid with cash or with goods and services within 1 year, or within the entity's operating cycle if the cycle is longer than a year. A long-term liability is a liability that does not need to be paid within 1 year or within the entity's operating cycle, whichever is longer. So this should not be new information for you. Current, within a year; long-term, longer than a year. Examples of current liabilities include accounts payable, which are amounts owed for products or service on account, typically due in 30 days. Those are current liabilities. Sales tax payable. Most states assess sales tax on retail sales. Retailers collect the sales tax in addition to the price of the item, and sales tax payable is a current liability because the retailer must pay the state in less than a year. Unearned revenues. Unearned revenue is also called deferred revenue. Unearned revenue arises when a business has received cash in advance of providing goods or performing work, and therefore has an obligation to provide goods or services to customers in the future. So I know we've talked about unearned revenue a lot. Somebody pays cash up front for your service. You haven't provided it yet, so you owe them that service. So of course, that's a liability. And they're current liabilities because they're going to do that within a year. Example of long-term liabilities include notes payable, mortgage payable, and bonds payable. So let's look at an example of a current liability. A common one, sales tax payable. Sales tax is usually calculated as a percentage of the amount of the sale. For example, suppose December's taxable sales for Smart Touch Learning totaled $10,000. The company collected an additional 6% sales tax, which would equate to $600. The entry will require a debit to accounts receivable for $10,006, the amount of the sale, and the amount of the related sales tax. In addition, there will be a credit to sales for $10,000 and a credit to sales tax payable for 600. So here's your example. We made sales, we got cash, we collected a little extra for the sales tax. So the total cash that come in is the sale plus the tax. So sales revenue, the 10,000, the tax, the 600, and that's payable. That's a liability. So at some point we'll send that off to the state. Now, I don't want you to worry about this percentage of sales tax or what that is. I'll just tell you for an exam. I'll just say, oh, the sales tax was $600. So you don't have to calculate that. All right, now, sales tax is not an expense of the business. It is a current liability. So remember, sales tax is not an expense. So you don't have sales tax. You may have tax expense, but sales tax is just kind of a pass-through. You collect it up front and send it on to the state. So it's not really an expense to the company. It is a current liability, so you put it on as a tax payable. Companies collect sales tax, forward it to the state at regular intervals. They normally submit it monthly, but it could be at other intervals depending on the state and the amount of the tax. To pay the tax, so at the end of the month or the quarter, whenever you pay that sales tax, you just show that you paid it. So you reduce sales tax payable and pay out the cash. There you go. No big deal. Debit sales tax payable, credit cash. Let's talk about income tax payable. All right. Now, income tax is the tax you pay on the income, right? We all know about that from paying our own income tax. Little companies have it too. That is an expense, all right? So remember, sales tax is just a pass-through. You kind of collect it, pass it on through. It stays on the books for a short time as a payable. Income tax does become an expense. So let's look at this. Federal government and many state governments require corporations to pay income tax on their net income. Federal income taxes are calculated on a corporate tax return, referred to as Form 1120. The amount of taxes that the corporation owes but has not yet been paid is classified as income tax payable and is recorded as a current liability on the balance sheet. So here's the example of it being recorded. So you sit down at the end of the year and you calculate your tax expense, your income tax expense, and you put that down, income tax expense, and you record it as a payable. You're not going to sit it in until the last possible minute, like April 15th, right? But you sit down, you calculate it, you say there's our tax expense for the year, it's a tax payable, we'll put it on the books. And then when you have to, you send in the cash, and of course you get rid of the payable, you pay out the cash. So the debit, income tax payable, and credit cash. It's a very simple transaction. All right. Let's suppose somebody gives us cash advance for doing some work. All right. So that means we're going to have one of those unearned revenues. Unearned revenue is also called deferred revenue. Unearned revenue arises when a business has received cash in advance of providing goods or performing work, and therefore has an obligation to provide goods or services to the customer in the future. Unearned revenues are current liabilities until they are earned. So here's an example. Suppose Smart Touch Learning received $900 in advance on May 21 for a month's work beginning on that date. So on May 21, because it received the cash before earning the revenue, the company has a liability to perform work for the client. The liability is called unearned revenue. So here you go, cash came in, cash is an asset, increases with a debit. So we got cash, debit, 900, unearned revenue, credit, 900. So that is a liability and it's a current liability. Now, during May, Smart Touch Learning delivered 1/3 of the work and earned $300 of the revenue. On May 31, the accounting clerk would record a debit to unearned revenue of $300 and a credit to service revenue of $300 to show that some of the work had been completed and some revenues earned. So as you earn revenues, you may recall this from the adjusting entries way back in guess it was chapter 3, we did this same exact transaction. We earned some revenues. So we need to reduce the liability. Unearned revenue gets the $300 debit, and revenue is always a credit, so service revenue gets that $300 credit. Notes payable. So we've done notes payable before. The length of time they're going to be outstanding is what determines whether they're a short-term note payable, or in other words, a current liability, or a long-term note payable. So short-term notes payable are a common form of financing. A short-term note payable represents a written promise by the business to pay a debt, usually involving interest, within 1 year or less, right? The 1 year is what makes it current. Assume on May 1, Smart Touch Learning purchased merchandise inventory with a 10% 90-day note payable for $8,000. The company uses the perpetual inventory system. The entry includes a debit to merchandise inventory for $8,000 and a credit to notes payable of $8,000. So here's your example. We bought some inventory, so we didn't get cash in, we got inventory in, so we debit the asset merchandise inventory and credit that liability notes payable, and because it's so short term, 90 days, less than a year, it's a current liability. Alright, so let's suppose we're going to pay that thing off now, right? So 90 days have gone by, we're going to pay that off. How do you do that transaction? Well, on July 30, when the note is due, Smart Touch Learning will pay the note plus interest, right? So notes payable will be debited $8,000, right? Liability decreasing with a debit $8,000. Interest expense, so expenses are always debits. So your interest expense, you know how to calculate that, principal times rate times time. So here in this example, 8,000 times 10% times 90 days out of 360. That winds up being $200. So the cash we got to pay out, cash, decrease asset cash, $8,200. Debits equal credits. Cash is credited $8,200 for principal and interest. Now here's an interesting concept I'm not sure we've talked about yet. It's called current portion of long-term notes payable. So it's pretty easy to imagine a note payable that's over 5 years, 10 years, 30 years, right? And some of that you're paying right now, right? So think about a car loan. Maybe some of you have car loans, and it's a 5-year car loan. Every month you have a payment. So some of that long-term note is going to be paid within the next year because they want a payment every month. So the part that's within the next year is the current portion of a long-term note. So that happens all the time. So companies figure out, well, how much of my long-term notes do I have to pay within the next year? And they put that on the books under current liabilities, and the rest goes under long-term liabilities. Long-term notes payable are typically reported in the long-term liability section of the balance sheet. If, however, the long-term debt is paid in installments, the business will report the current portion of notes payable as a current liability. The current portion of notes payable is the amount of the principal that is payable within 1 year. The remaining portion of the note will be classified as long-term. So it's pretty easy to think about if you're setting up your balance sheet and you put your accounts payable in the current section, you put your unearned revenue in the current section, and you have a mortgage that's a 30-year mortgage. Well, you're paying on it every month. So 1 year goes in the current section, and then 29 years goes in the long-term section. So you just split that out. You divide, let's say you have a $300,000 mortgage that's 30 years. So you're going to pay $10,000 this year. So you put $10,000 in current liabilities and $290,000 in long-term liabilities. So that's how that works. All right, so let's stop here and we'll pick up with the next part on the next video.